What do you think is going to happen to the real estate market the next 6, 12, 18 months?
My answer to that question will be that the situation today for real estate, and I'm talking about residential, of course, there is also commercial real estate. That's a different story. Retail and office space and things of that sort. But if you're looking at residential, I would say the good news might be that things are not going to get as bad as they did during the subprime bubble and bust and the global financial crisis. Because in that episode, what happened was that the bubble in home prices was much worse than today. There might be some frothiness in home prices today, but say the ratio between average price of a home to the average household income, or the ratio between the price of homes to rents was really stratospherically out of place. Two, as prices were going higher, there was a massive increase in the supply, many new homes being built, and that supply was going into speculative demand. Mm-hmm. People buying homes just for, say, condo flipping. So once it burst and the speculative demand disappeared, mm-hmm. the excess supply of housing implied that the price collapsed 20, 30%. Many people were essentially having no equity in their homes. They could not essentially pay their mortgages. They walked away from their homes. And once the recession was severe, people didn't have the income to pay also for their homes. So we had a real severe recession, bust of housing. Today, instead, first of all, those measures of a bubble in the housing market are showing frothiness, but not a massive bubble like 2006, 2008. Two, the economy is still growing. So the household might have a balance sheet problem. The interest rates are starting to pay on the mortgages is higher. But if you have a job and income, you can still afford it. Mm-hmm. Mm-hmm. Three, when interest rates were very, very low, as of 2 years ago, you could get, as a prime borrower, you could get a 10-year mortgage for 2.5% to 3%. Today is 7-8. Many people locked in mortgages at long maturity, 10, 20, 30 years, at interest rates that are much lower. So the average person is not paying 7-8%. The average is paying something like between 3 and 4. Some people less, some people more. And people have jobs. So are we going to have a downturn in real estate? Yes. Is it going to be more severe in commercial, meaning offices and stores and so on? Yes. Could there be risk also for housing? Yes. But if we avoid a real recession, people have jobs and income, and they have now locked in, interest rates are lower. As some of those mortgages refinance, then people are going to find much more expensive to pay their mortgages. And today, I would say, given the ratio between prices and rents, it's much more, much more reasonable for an individual to rent rather than buy. You want to wait to buy only when mortgage rates are lower or prices have fallen 10, 15%. So if I had to give an advice to anybody, I would say rent today, wait until mortgage rates are lower and or prices of home are lower. Is not a good time to buy.
And I don't know if you saw the numbers. It said what, 52% cheaper right now to rent to buy.
Yeah, that's correct. And there's other stats that support what you're saying. Right now in America, 61% of the total mortgages in America are held at under 4%.
What percentage?
61% are held under 4%. And 81% are under 5%. And if you looked at it as a band, about a quarter of them are 3% to 2.5%. 38% of them are 3 to 4, and 20% are 4 to 5. So to your point, sir, people that go, say, from migration north to south, you could Airbnb, which is another phrase for just rent your old home. And, if you're a retired person, rent something in any of the southern Sun Belt where you go for your winters when you, not for extravagance, just as you go down for the winter, the way the retired folks go. The other side of it is there's a little bit of a tick up in foreclosures for subprime, but I read this morning that even if that peaks out, it probably only adds 50% to the current inventory, which would still keep it like only 40% of the historical average. So in other words, if the subprime inventory comes out through foreclosures,
yes,
the inventory for sale right now is still so low, it's just going to bring it up a little bit, and it's going to be more.
It's not going to be dramatic where it's going to be felt.
Spot market.
Well,
the other thing I read that was very interesting is who owns the houses that are being that are being discounted. The homeowner discounts the rates much slower, and it was the foreclosure glut and the banks that dumped the assets they were holding. Because you and I have a bank, all of a sudden we have 4 houses and no mortgage behind them. We're like, holy crap, we sell them. And we dropped the price. So the banks were the ones that started the snowball of the price dropping, because Pat and Tom's bank, we're not making interest on that. We got property tax, we got insurance. Get this thing off my balance sheet.
Yeah.
And so we tossed it out.
I want to show this, Dr. Nouriel. If you can pull this up, Rob. I know I'm not going to be able to see it. As long as he sees it, that's what I care about. I saw this the other day, and for me, I'm always wondering, who is going to predict the recession more accurately. Do they know something the rest of us don't know? As long as you see it, I'm good. Whenever you see it, if you can just tell me you see it, it should say, what's next for the U.S. economy, 2024 projections. Are you able to see it?
Not yet.
Okay, Rob, let me know when you have it so he can see it. On this chart, before he brings it up, I'll just read it to you. It shows 7 different brackets. And these brackets are showing what is the percentage, who thinks a recession is coming, okay? Fed staff, 0%. They don't think recession is coming. This is people that work for the Fed. They don't think a recession is going to be coming. Yield curve, 61%. Economists think 48% chance a recession is coming. Consumers, 69% chance they think a recession is coming. Goldman Sachs is only at 15%. Bank of America is at 35 to 40%. However, CEOs of larger companies, they're at 84%. CEOs of larger companies are at 84%. So why would CEOs of larger companies be at 84%? What do they know that the rest of us don't know? Now, if you, of course, study this, a lot of these companies, when money was so cheap, everybody was saying, guys, let's go get some money. 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 Money is so cheap. Some of them put it to work. Some of them, put it in a, treasury and they made interest on it. But for the most part, some of these guys are paying interest rates that they're worried if it gets called a year from now, 6 months from now, their interest on the loan that they took, some numbers have shown it's going to go from $530 billion this year to $780 billion next year. Then it's going to crack $1.1 trillion, then $1.3 trillion in the next 3 years. And these are interest payments that they have to be paying. That's a lot of money. Why do you think CEOs who are in the business think a recession is more likely than the rest of the other 7 communities?
Yes. First of all, that chart shows that there is a whole distribution of views among different groups, even among economists. Some are optimistic, some are pessimistic. Mm-hmm. I'm sure that's the case also among a variety of CEOs. So the honest answer is, as I said, when it comes to predicting the future, you can only do a bunch of scenarios and try to assess probabilities. 6 months ago, the staff of the Fed had a recession, short and shallow as being their baseline. Today, instead, they say their baseline is no recession. So that probably has gone for them, not to zero, but the baseline is a soft landing rather than a short and shallow recession. Additional point, when people say there'll be a recession, is it going to be short and shallow? Is it going to be more severe, associated with a banking financial crisis or not? And is a recession next 12 months, as opposed to after the presidential elections? If a recession were to occur before the next presidential election, it's going to have impact on whether it's going to be Trump or Biden winning. Even a short and shallow recession, if it occurs in 2025, the implications are going to be different. So even the question has to be more specific. I think that the CEOs, in my view, are concerned about several things. First of all, while during the global financial crisis, the problem was too much debt of households, mortgages and lending by the banks, in the last 10, 15 years, there has been a massive buildup of corporate debt. Corporations have borrowed like crazy, and they've been financed less by banks and more by what people call shadow banks, non-bank financial institutions, a variety of capital markets, hedge funds, private equity firms, and you name it. There is already a lot of debt that is what's called junk bonds, below investment grade, of people that have so much debt that is risky, and the spreads that you have to pay on it is much higher than investment grade. There's $1 trillion of what people call fallen angels, debt and firms that were investment grade and now they've been downgraded to junk level. There is another $1 trillion of corporate debt that is barely investment grade, one step from being downgraded. And in the private markets, there's been a massive buildup of private debt, not financed by banks or capital markets, and things like what people, exotic instruments like leverage loans, CLOs, peer-to-peer, private debt. A lot of it has been done in very risky ways without safe covenants. So, and some of this debt by the corporate sector, like the household, during the COVID crisis was refinanced at lower interest rates at longer maturity, but several $1 trillion of this corporate debt is coming now to maturity in the next 1, 2, 3 years and so on. And if interest rates remain high, those firms that were borrowing at low rates, like household, will have to refinance themselves at much higher rate. Now, like for the household sector, today, there is a balance sheet problem. You have a lot of debt, and the interest rate on that debt is rising. But you don't have yet a P&L problem, meaning an income side, because the economy is still growing, profits are still positive, revenues are growing. So yes, corporates like household are strained on the balance sheet, high debt, and gradually interest rates going higher. But as long as households have jobs and incomes, rather than being unemployed, as long as firms have revenue growth and profits, they can still manage the interest payments on those liabilities. If instead there is a recession, you get a double whammy, a shock to your balance sheet, high debt and rising interest payments on the debt, and then a hit to your income statement, your revenue, your income, your profit, your employment, and then you get into a severe financial distress. So the bad news, debt ratios are high and debt servicing ratio are rising. The good news is that income, revenues, profits are still rising, and therefore, for now, even the corporate sector can afford it. But CEOs are becoming nervous that eventually this large stock of debt at higher interest rates is going to become unsustainable. They also look at global risk of various sorts. And of course, the geopolitical risk are a threat. If energy prices were to rise even more so, because there is a regional war between Israel, US, and Iran, not just against Hamas, that shock to oil prices is going to lead to inflation, recession, stagflation, like the 1970s. This is some of the things that might be on the mind of the corporate leaders.
So if you like this clip and you want to watch another one, click right here. And if you want to watch the entire podcast, click right here.